This is the second video on GDP. We know what is gross domestic product at market prices, and this can be abbreviated as GDP MP. And there are three important relationships that you should know about as they relate to GDP MP. The first one is a relationship between market price, the price you pay as consumers, and factor cost. And factor cost is the cost of producing and selling a good. And the difference between these two is indirect taxes, the taxes that are levied on expenditure side, like sales tax. So market price is equal to factor cost plus indirect taxes. The second relationship we should know about is the relationship between gross and net, and these two are related through depreciation. Depreciation relates to the loss in value of a machine. For example, you buy a machine for $1,000 and it is expected to last for 10 years. Then every year you are losing about $100 in terms of value of the machine, and that is called depreciation. Once again, gross equals net plus depreciation. The third relationship you should know is the relationship between domestic and national. And these two are related to what we are called NERO, which is net income from rest of the world. Now, when we use the term domestic, domestic refers to residents of a country. For example, when I was an Indian citizen and I was working in the US, I would be called a resident of the US. But since my citizenship lay with India, I was considered a national of India. So domestic refers to residents of a country, national refers to citizens of a country, and these two are related through net income from rest of the world, of which we have abbreviated as NERO. To understand the relationship between domestic and national, look at the following. Suppose in the US we have foreigners working, people like me earlier, and we have US citizens. And US citizens earn about $85 billion a year in terms of income. Foreigners, on the other hand, earn about $5 billion as income living and working in the US. Then we have rest of the world, other countries in the world where you might have some US citizens who work in other countries, and they make about $10 billion a year. So based on these numbers, what will be domestic income of the US? It will be income of US citizens plus income of foreigners working in the US, and that will be 85 plus $5 billion, and that equals $90 billion. What about national income? National income of the US will be just the total income of US citizens, whether they work in the US or anywhere else in the world, and that will be 85 plus $10 billion, and that will be $95 billion. And so based on this, what is net income from rest of the world? It will be income of US citizens working overseas minus income of foreigners working in the US, and the difference will be $5 billion. So when we are looking at income of nationals, we are just looking at income of citizens of a country, whether they live and work in their own country or they work elsewhere. So to repeat, these are the three relationships that you should know. Market price is equal to factor cost plus indirect taxes. Gross equals net plus depreciation, and domestic equals national minus net income from rest of the world. So based on the definition of GDP MP and the relationships, three relationships that we talked about earlier, we can derive a lot of measures that relate to income of a country, and it is much easier to understand the system how we get all these concepts that relate to income of a country. The first letter could be a G or an N, and the first letter G would represent gross. The second letter which is possible is N, and that will refer to net. And we know based on the relationship that gross and net are related through depreciation. The second letter in terms of nomenclature of income of a country could be domestic or N national, and these two we know are related through NERO, net income from rest of the world. The third letter will be a P, which is just product at, and this has to be evaluated at MP, which is market price, or factor cost, which is represented as FC. And so FC is factor cost, MP is market price, and these two are related through indirect taxes less subsidies. So based on this, if you understand the system, we can derive GNP-MP, which is gross national product at market price, NDP-MP, net domestic product at market price, NNP-MP, net national product at market price, and so on. To understand how we get different concepts relating to income of a country, consider the following example. GDP-MP of a country, let's call this country beautiful country, is $1,000 billion. Income earned by citizens of this country working overseas is $50 billion. Income earned by foreigners living and working in beautiful country is $100 billion. Indirect taxes less subsidies is $200 billion, and depreciation allowance is $250 billion. Now, based on this GDP-MP figure and the fact that we know about those three relationships, NDP-MP, which will be net domestic product at market price, will equal GDP-MP, which is gross domestic product at market price. So the difference between G and N, the first letter is depreciation. So we subtract depreciation from here, and that will be $1,000 billion minus $250 billion, and that will give us $750 billion NDP-MP. Now we know GDP-MP, we can derive GDP-FC. And what is GDP-FC? This FC is factor cost, and this is related to market price. So we already know GDP-MP is 1,000 billion, and if we remove indirect taxes less subsidies from there, we get GDP-FC. And so 1,000 minus 200 billion will give us $800 billion, and that will be GDP-FC. The third thing we can find through all this is NDP-FC. Now we know what is GDP-FC, and the relationship between G and N, the first letter is depreciation. So we know GDP-FC is 800 billion. So we just remove depreciation from there, which is $250 billion, and we get $550 billion. Now I've just copied the same example from the previous slide, and we have NDP, which we have calculated, NDP-MP 750 billion, GDP-FC 800 billion, NDP-FC 550 billion. And now based on this, we can derive other concepts relating to income of a country. For example, GNP-MP. Now it's the second letter which is different from GDP-MP, and this refers to national. And we know domestic and national are related through NERO. So to domestic income, if we add NERO, what will be NERO? It will be income of citizens working overseas minus income of foreigners working in this country, and that will be negative $50 billion. And if we add this to GDP-MP, we know GDP-MP is 1,000 billion, so 1,000 plus 50 billion, which is the income of citizens working overseas minus income earned by foreigners, and this will give us $950 $750 billion as GNP-MP. The next thing we can find out is GNP-FC. Now the difference between GNP-FC and GNP-MP is the difference between market price and factor cost. So if we knock off indirect taxes less subsidies from GNP-MP, we'll get GNP-FC, and that will be 950 minus 200 billion, and that is $750 billion. Another concept, NNP-FC. What is NNP-FC? It is GNP-FC minus depreciation, the difference between gross and net. GNP-FC we know is 750 billion. From this we remove depreciation, which is 250 billion, and what we are left with is NNP-FC. And just remember, NNP-FC is also referred to as national income of a country. The last one I have derived is NNP-MP, and that is the difference between GNP-MP and depreciation. So from $950 billion, we remove 250 billion. Oops, I forgot to write billion here. And this will give us $700 billion. So based on one definition, that is GDP-MP, and the three relationships, we can derive a number of concepts that look at different aspects of income of a country. And this concludes this lecture video. Thank you for your time.